Welcome to this week's edition of Navigating the Markets with me, Markets and Mayhem, coming to you Monday, November 11th. And happy to have you all here. Happy to bring this segment back. It's always been a lot of fun. Took a little hiatus, and now I want to kick things back into motion with a really awesome edition of Navigating the Markets that I'm very excited about. And I'm glad to have you all out there tuning in. Now, if you're not able to watch the whole episode, fear not, because it will be recorded. In fact, it is being recorded, and it'll be posted shortly after we wrap up. Usually it just takes about a half hour, an hour for post-production and all that fun stuff. So as we dive in, let's quickly get through the risk disclosure because no presentation is complete without that. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. Let's talk about today's heat map a little bit because I do sense a theme that is in its earlier iterations, in my opinion. I think we're going to see a rotation out of some of the larger tech names and into some of the less appreciated, less loved parts of the market. And, you know, you could say that we've actually started to see that since mid-July into the present, that we've seen a rotation into other areas like financials, like industrials, materials, etc. And I think that is set to continue. And we'll talk a little bit more about that, as well as some of the Trump trades I think could work during the next administration, because really, you know, as we go into 2025, we have to shuffle the deck a little bit. We have to look at what's ahead of us. What does that look like for us as traders and investors? And how can we best capitalize on those trends? So towards the end of the presentation, I have some content. I'm going to share my thoughts about that. But as we get primed up here, I want to share some analysis on what's happening right here and right now, focusing on the S&P, and then we'll get into some of the other areas of the market. So first, we have the distribution of options positioning in the S&P 500. And you can see 6,000 is the level to watch. In fact, we closed right at it today, 6,001. And the vast majority of options volume was right there at the same level, right at 6,000 throughout the day. Now, if you were tuned in to my live stream during the day, you probably noticed I kept saying, I think we're going to get pinned around here unless we really make a decisive break. And there was a moment in time where it looked like we were going to break down, and we can see it on this chart here. This is from the SPX Options visualizer as seen in Motive Wave. You could see we had that draw, but we popped right back up and just sort of stuck to 6,000 for most of the rest of the trading day. And then into the close, we sort of briefly popped back up and then started to fall down just a little bit there. So it does give you a sense that this is a market where options are playing a bigger than life role. They have been for really 2.5 years now, if not longer. You could even say 3 years. But the other thing to take note of is that it's options expiration week. We have a really illiquid order book in the S&P 500. There's like today, there's about 44,000 order book depth when I last checked on it. So it means that it doesn't take a whole lot to move price, but also just how big, and we'll go back to this other chart, how big that 6,000 level is. You can see there's not a lot of positioning rolling higher. That actually matters because until we see conviction grow at higher strikes, we could also get stuck here. So, you know, often is the case recently in options expiration weeks, we have a sort of gamma clenching effect where we get stuck to a level and we just kind of get glued to it magnetically until we break away from the week, or if not a level, a range. I think we do have the potential for that type of an environment this week, that we could get kind of stuck here. We're still in an uptrend. That is still intact, and we'll talk about that a little bit later. But at the same time, we have some risk that we could move sideways, maybe a bit lower in the short term and in this options expiration week. We also have some key event volatility catalysts like CPI coming up on Wednesday, PPI, and a Powell speech on Thursday that could move markets to some degree. So going back to the SPX Options visualizer, the other thing you'll note is that these key levels that were areas where people were transacting pretty aggressively today, they ended up being areas where we could reliably say as short-term traders, we can expect price to transact there, particularly the most active call and put area. We actually had S&P 6,000 throughout the day become the most active area of calls and puts transacting on the chain. And I do think that some of this has to do with options expiration week, but I also think it has to do with how big of an exposure area it's been and how much that's really starting to matter to the market. Whichever way we break from this level is going to be pretty decisive, I think, in the sense of how it sets the tone, particularly going into next week when we become unclenched from this extraordinary amount of gamma exposure at 6,000. Now, some options specialists have said the further we move above 6,000, you could have a bit of a chase effect from dealers. You could have buying kind of beget more buying just because of how much short gamma is there. But my own take is that until we make a decisive break in either direction, it's time to really look at this as a market that's more in a period of consolidation, figuring out how it wants to move. And that's a lot like a coiled spring. You kind of get this energy pushing on either side, creating the potential for whenever we do get that break, it could be a pretty big move. And typically I look for about 7 to 8 handles of movement the other way, some degree of acceptance built, and then we can have an extension beyond that initial break. Let's take a look at the trends too. We can see with the S&P 500 here, you do have a pretty clean trend line where every time we hit it, we either get rejected immediately or we kind of look above and then break right back down. So this trend line has been pretty clean this entire rally. Guess what we poked today? Pretty much kissed it on the nose and rejected. That was the gap up we had to start the trading day from the overnight session and Friday's close. We had that gap up in regular trading hours that was summarily rejected from the first hour onward. So that was another thing to pay attention to, because when we were trading today, we didn't see a lot of conviction by call buyers. A lot of that call transacting started off around, say, 60, 70, and then it just kept, and that's an ES term, so it was like, like 60, 50 or so, or 60, 45 in SPX terms, and it just kept dropping and dropping and dropping until the most active call strike came down to 6,000 SPX, or about 60.27 on ES. And that just gives you a sense. There wasn't a lot of conviction on either side. The distribution of flows was also pretty equal. There was a similar amount of volume transacting in calls and puts today, which also tells you neither side really had much of a tactical advantage going into this trading session. So those are things to contextualize as we get into the latter part of this week. Tomorrow, Tuesday the 12th, I do expect we'll see some more just-in-time hedging flows. I think we saw a little bit of that today. And that would just be telling you that because there's so much vol selling that happens these days from funds, from traders, from strategy ETFs, where all they do is sell vol or have that as a part of their strategy, that hedgers are better served going in just in time. So we've seen sort of a depression in skew from more normalized levels with positioning this high, but then we see these episodic pops in skew where there's this just-in-time hedging. And for those that don't know, skew is essentially the distribution of premium, the difference between puts and calls. It's always been on the put side since the 87 crash, as hedging patterns have changed in the SPX options complex. So what we're really measuring is just how much further on the put side is that SPX skew lopsided. The more it is, the more likely it is you're in a well-hedged market environment. And so it was interesting. We'd seen the week before the election, there was a lot of put call and the index. It was a very high spike and folks were saying, oh boy, there's a lot of put buying. But actually, if you looked at skew, if you added that nuance, you would have seen, no, they were actually selling puts ahead of the election. It was like an idea of basically getting ahead of the potential vol compression. Now, if they were wrong, that would have hurt, but they were right. And they made a whole lot of money on that vol compression that followed. So if we look at skew with that sense, we can see that going into options expiration week, where skew starts to matter more for those Vanna and Charm flows that help to buffer the market higher, it's subdued here. So this is not a particularly well-hedged market. We'll see what it looks like going into tomorrow and after tomorrow going into CPI day. But I imagine we'll see a little bit more of that just-in-time hedging, and that can pull a little bit of liquidity out of the market. So it's something to pay attention to, particularly first and last hour. I've noticed a lot of the institutional trading desks really prefer to do more of their activity then because it's much more liquid. So that activity tends to be more well absorbed by other market participants. So watch for how we may see put flows take shape in the first and last hour of tomorrow's trading, because that could also give us a sense as to how well hedged that market is, combined with the differential and skew we see day over day going into options, going into CPI, going into PPI, Powell's speech, and of course, options expiration Friday. Now, I do have some key levels for you all to watch. You're welcome to screenshot this for later. These are levels that I share on the Trader Aid Discord pretty much every night. They're also part of a stream that we have for the intraday levels that are updated minutely throughout the day. So be sure to check that out under the ES Pivot stream, where you can see these levels as they may be interacting with market pricing. And these have been pretty decisive. These are not just random levels. These are programmatically generated based on how market participants are transacting. So this is something that I've been working on and trying to make more and more accurate as time goes on, and now it's pretty much hit its stride. I haven't had to do much tweaking to it. It's been pretty much working as intended and helping us to qualify support, resistance, and where extensions may end in both rallies and drawdowns. Now, the NASDAQ has a pretty similar look as the S&P. You see this trend line from that August low, the top that we had before it, and where that has been an area of resistance coming into now. Now, I'm not suggesting that this leads to this, but it could at least be the early signs of a potential sort of corrective or consolidative draw. We really need to see how both the S&P and the NASDAQ interact with this trend line, because every time prior, it has been formidable resistance. So there's no reason to suspect it's going to be different this time. What would change that in my mind is if we really do start to build acceptance above it during the trading day, and most importantly, close above it, so we can say, okay, at least for now, it looks like we've cleared it. Now, let's take a look at gold. A lot of folks have been talking about gold. I think, as I've been suggesting previously, that it is due for some corrective impulse, a little bit of selling. We've had a lot of euphoric flows into gold options and funds. We've heard it become the chatter of the financial media, and a lot of folks who are analysts getting super bullish on gold. The good news is we haven't had that parabolic move in gold, right? You're actually seeing that in Bitcoin more than anything else. Parabolic moves don't often end well. If they continue to move and build on that parabola, it just tends to usually reverse, sometimes more violently than the initial move. Gold's uptrend has been much more constructive, much more of like a stair-step pattern higher, which is exactly what you want to see. That's the sort of orderly movement in gold that tells you it's less likely the bull market is ending in gold. It's more likely that we're regrouping. Now, we could correct lower. I'm looking at 26.20 as key support. We bounced off that level today, testing it and bouncing above 25.60.70, the next level, and then 25.13.10. Those are three levels of key support that I'm looking for. If we break below that 25.13.10, I'm going to be thinking we could be going into a longer period of correction in gold, and I'd be less interested in long plays at that point. For now, I would look at each of one of these levels as areas to potentially regroup and nibble a little bit to add to exposure, especially if one was taking profits at around 2,800. And we can see with today's price action, we've decisively broken that uptrend line that we had going in from summer. So that is a concern for buyers. That is not something we necessarily want to see, but seeing it playing out, it tells us we do have some room to move lower or at least consolidate from here. That for now, it's healthy for this thing to pause and go down to sideways, but the uptrend, the larger uptrend, the multi-year uptrend is still very much intact. And if you look at this in Bollinger Band squeeze breakout theory, we are still seeing that breakout from a very long period of squeezing, which just kind of gives you a sense, like the spring, when you push it together and you let go and it expands very quickly, we've still got that energy left from that period of consolidation into this period of price volatility expansion to the upside. But it is normal and healthy and even desirable to have pullbacks in a healthy bull market. Silver has a somewhat similar look here. Silver pulling back here to the high 30.82 level with support just below. We have broken below the trend line, so that means we're entering more of a corrective impulse here, or a consolidation phase. 30.41, 29.08, and 28 and a penny are the three levels I'm watching very closely on silver here. I'm not terribly concerned about the longer term health of the trend yet. But I think if we break below 28, that's where we could get a much more meaningful amount of downside. So I'd really like to see these levels hold. They would be areas where I'd be considering adding to exposure in both the metal itself and some of the premier quality companies in the space like SVM. I do think that silver is a lot different than gold. I don't think we can compare the two in any way that is fair. Silver is an industrial metal, plain and simple. 50% of the demand for silver is industrial. That's not like gold. Gold's industrial demand is de minimis in comparison. And silver investment is much smaller. It's like 10, 15%. And then there's some degree for jewelry, although that's not really the same thing at all. So when you look at the two metals, you have a totally different picture. Can they run in tandem? Absolutely. If you have the two legs of silver going strong, and that is investment demand, but most importantly, industrial demand, that's where the metal really can run. And it can run incredibly fast because it's not a very liquid trading instrument. So, and there's also a pretty large structural deficit in global supply that can emerge if industrial demand picks up. So what are we looking for there? We're looking for the US and Chinese economy to start to gain ground, particularly in China. And that's been a challenge because the government there has been reluctant to stimulate in size. So I'm still in the mindset that silver has yet to make its biggest move to the upside, but that theory relies off the Chinese government. And I know you're like already saying, Mayhem, what are you doing? You're relying off the Chinese government for anything? Like, what are you doing, man? You can't trust those guys. Look, I get it. But they do have a situation where they have to stimulate. Like, there's pretty much no choice at this point. So I do think that they're going to stimulate, and I think it's going to be a pretty significant size, but I think it's going to be a 2025 story, and it'll be trying to counterbalance the impact of whatever Trump's policies are towards China by them unleashing their own stimulus in an effort to increase domestic demand, and to some degree make their exports more competitive, because if they stimulate, probably weakens their currency, makes their exports a bit cheaper. Maybe if they target that stimulus domestically, it also improves retail sales, kind of get a 1-2 punch out of it. That's what I would expect. I would expect a multi-trillion yuan stimulus in 2025, probably the first quarter. And if we do get that, and it really does start to increase the demand in the Chinese economy, I do think at that point, you start to see the potential for silver to really run. Right? That's what I'd be looking for there, because at the end of the day, I think the Trump administration is going to do a lot for some of the older economy stocks, and we're going to talk about that in a little bit. But in doing so, and in stimulating industrial demand and those older cyclical industrial components of the economy, it is quite likely that we're going to see silver prices, copper prices, iron ore prices, and a number of other industrial metals pick up as well. So that would be what I'm looking for silver. We really have to hold these levels here. Otherwise, we could get some deeper selling. So for the meantime, I'm looking at intermarket dynamics to get a sense of directionality, because we haven't had a lot of catalysts for either gold or silver. Gold is more of an uncertainty hedge. There's really no easy way to value gold because the supply and demand dynamics are completely different. Like almost all the world's gold that's ever been mined is still out there. It's not consumed that much. And even when it's used for industrial purposes, a lot of it's reclaimed through recycling. So most of the gold that's ever been out there is still out there. Silver is not the same. In many cases, it's more costly to get scrap silver unless the prices are pretty significantly high. And also, you just have more utilization of silver for longer term purposes, like for communications, for military, for even some of the guided missiles out there, for renewable energy like solar and some of the newer battery tech, for computers and otherwise. Silver gets used, and it's sort of out of pocket for a while, which is one of the reasons that you can have these supply deficits where there's not enough production and not enough overall stored supply to meet aggregates of demand. And the only way markets can deal with that is to have prices go higher. Right? So that's what I'd be looking for, but we have to see the industrial demand come back. And so in the US, I think the Trump administration will do what they can to stimulate the older part of the economy. I think that's going to cause tech to lag and some of the older economy components to lead. But we also want to see from that in the US and China applications that are beneficial for the silver industry. And I do think we'll see that, but obviously, like any other trade, we actually need to see it play out. We need to see those macro head posts, right, along the way, confirming what we're seeing in momentum. So right now, I would say it's on pause because we're sort of in this lame duck period between this administration and the next administration. So I wouldn't expect anything big until after the inauguration from the US. And China has pretty much told us we're not going to do much more this year, and we're actually saving up. They've said this now, and they're really saving up their fiscal stimulus to see how they may need to buffer their economy and stimulate it in light of what the Trump administration may do targeting China. So these are all things we need to consider, that this is the time, as it kind of finds this new consolidation range and possibly corrects, that these may be some of the opportunities to scoop up some of the metal as we get into, a phase of kind of distribution where smarter folks are going to be accumulating if they believe the same thing. And if they start to see the markers on the road that we're going to get there, that we're actually going to see more robust silver demand. Now, turning the page back to equities, we're getting back into peak buyback season, right? This week, we could see the chart goes vertical. So we have that constructive demand. Buybacks are one of the biggest sources of liquidity that is accumulating shares in the US market. Foreign investors are another large source. Pensions and mutual funds, not as large as you would think. Retail investors, yes, but really buybacks are a huge part. And this is the biggest buyback cycle projected that we've seen in years. So we talk about the Santa Claus rally. We talk about November and December seasonality being constructive. This matters because one of the reasons that happens is the flow of buybacks. And this projection suggests that that flow is going to pick up markedly, really from this week into December, and then it's going to start to fall off again as we approach the next earnings season for Q4 earnings season early next year. So take that all into consideration, that you, in the absence of some of that Vanna and Charm flow that is supportive, we do have some of those buyback flows. They're largely targeting the bigger companies that are buying back their own shares. And let's talk about the stock market from a totally different perspective for a moment. I'd be remiss if I didn't put on my risk manager hat for a minute and at least discuss some of the concerns that are out there. It doesn't mean I'm overtly bearish, but it does mean that we need to appreciate some of the risks that exist. We wouldn't be good traders and investors if we didn't look at both sides of the ledger. So one of them is that U.S. private sector financial assets are basically at a ratio of 6.3 times GDP. That is significant. The last time we saw them that high was before the 2022 bear market in late 2021. That doesn't mean that we're headed for another bear market immediately. It just gives you a sense that things are just a little stretched here. It's a very simple metric to look at relative concentrations, and it just gives you a sense that, maybe you want to be careful where you are in these financial assets. Because it's not just in private financial assets, it's also in public financial assets like equities. And we can see stock market exposure here as a percentage of U.S. households is very, very elevated. It is at an all-time high. The last time we saw a high like this was, again, late 2021, and we know what happened next. We don't need to go over it again, but also at the height of the dot-com boom. Now, past is not prologue. So the reason I mention this is instead just to open up our other ideas of how we may manage risk into a situation like that. I have some of my own ideas. I'll be sharing them with you as we go throughout the rest of this presentation. Then we'll get into Q&A. And if you all have any questions, you're welcome to ask them now. I'll be looking at them in just a little bit. But basically, what we're looking at is just a really, really large concentration of exposure in equities on a relative basis. And the reason that matters is this next chart, that the valuations on the S&P 500 are also very extended in certain areas, especially like the mega caps, where they're seeing slowing revenue and slowing sales and slowing earnings growth. It's not slowing sales and earnings. It's slowing sales and earnings growth, right? And valuations in part are predicated on that growth. So if the growth's slowing, but the valuations are growing, there's a disconnect we need to be somewhat concerned about. And that gives us an idea as to where we do want to be, but also where we may not want to be. So let's just keep those two charts in the back of our mind, that there's a lot of exposure to stocks. If we're putting on our hat and thinking about how that exists, it's largely in passive and active allocations in the largest companies of the S&P and NASDAQ, and those are largely big tech, right? So we've already talked about maybe we could see a bit of rotation out of that and into other areas of the market. Now, if we look at sentiment, we can see that sentiment is rather stretched here based on Goldman Sachs's positioning indicator, and it's basically using a relativistic approach. It looks at positioning scores, I believe, over a year time frame, and it basically gives you a sense as to when people might be getting a little more euphoric based on just how differentiated that positioning metric is versus prior times during that past year time period. Right now, this is stretched positioning, which makes sense with everything else we've looked at, that you would think, okay, things are getting maybe a little bit ahead of themselves in positioning, and that would make sense. And it's also important to contextualize where, right? And we're starting to see outflows from the most concentrated part of the market. That is tech. Right? We all kind of suspected this would happen at some point. We saw it in the heat map today, and we've seen it, day in and day out as a theme really since midsummer, that tech has overall been lagging the way it had performed earlier in the year. And that's important because that does tell us that folks are selling out of some of their tech exposure and rotating into other parts of the market. For example, equal weight S&P versus market cap weight has been a trade that is working and I believe could continue to work. I also think we could see value outperform growth. I think that is a pair trade that could be potentially worth looking at over the next year. And I think we could start to see some more outperformance from mid caps versus large caps and mega caps, which has been a trend over, believe it or not, several decades that mid caps have been outperforming. I think we could see that pick up some more as well. So it's sort of looking at different factor matching and see where there could be relative underperformance versus outperformance. I believe there will be some very juicy setups in those areas and some others that we're about to go over. But first, because it's a week where we get to learn more about the inflation picture, it does appear that inflation progress is starting to stall just a little bit here. And I think that's important because CPI core getting stuck about 0.3% would suggest annualized core is about 3.6%, which is certainly a lot higher than what the Fed might want to see, which will likely cause them to slow their roll in rate cutting. And we'll talk about that in just a moment. But what's important about this is that we have a lot of upside catalysts for inflation that are not well priced. And I think those are things that could materialize if we get a larger round of stimulus from China. At the same time, we get a bit of a push to further increase economic activity in the U.S. during a time where central banks around the world are also cutting interest rates, reducing the cost of capital, and as a result, likely increasing demand. And if we talk about inflation in the United States, it's a very K-shaped story. That has been a bit of a theme throughout many different areas of the economy and the markets. Wall Street measures inflation through the rate of change, right? And we consumers and everyone else in the world that spends money on products, we measure inflation by cumulative costs, right? We don't sit around the dining room table discussing our bills saying, inflation's down to 0.3% this month, so that's really good for the rent or the utility. No, it doesn't work that way at all, and it never will. It's obviously about what is the price we're paying today. Now, obviously, if the rate of change is higher, that sparks alarm, but what's more important is where is your real wage versus your cost of living? And is there enough slack between the two that you can build a buffer for savings? A number of the lower tiers of consumers, small businesses, some of the more fragile banks, they've also been on the wrong side of this K-shaped recovery. So that's something to take into consideration. There is some vulnerability here. It is one of the reasons, ostensibly, that the Fed is cutting rates with the market at all-time highs, crypto at all-time highs, housing prices at all-time highs, gold prices near all-time highs, and yet the Fed has cut 75 bips so far this year with another 25 likely next month. So what does that tell you? It tells you that they're trying to relieve some of the stress in pockets of the market and the economy, but on the other side of it, with the economy as resilient as it is in aggregate. That is to say, yes, there are consumers, small businesses, smaller banks that aren't doing well. But if you look at the aggregates of data that include everything, the picture is a little bit different. right? Folks are doing okay in the aggregates. The labor market hasn't melted down, right? We haven't seen a big shoot up in unemployment. We haven't seen, a large slowdown in GDP or other measures of consumption. So what that tells you is it's likely we're going to see a more shallow rate cutting cycle. And that will impact a number of different asset classes. It could also eventually catch up elsewhere. So that's important because right now the number of quarter point cuts priced in for the end of 2025 has fallen markedly. In September, it was looking like, we could get as much as 2.5% rate cuts priced in by the end of 2025. Now it's looking closer to, we might get 3.5 25 bip rate hikes, which is less than 1% of rate cuts for next year. So imagine going from thinking, boy, we're going to get 2.5% to less than half that in just less than 2 months. So that's a pretty significant change. And I think that will have ripple effects in some areas of fixed income and in some areas of the riskier parts of the market. Not quite yet. We're in the very strong period of seasonality. We'll talk about that. But basically, I kind of joked about it yesterday that, this is the time of year to kind of buy small caps and hold your nose and hope for the best. And it really has a lot to do with seasonality. It's not that I like the Russell. I think it's an index full of garbage, but November is the best month of the year for that. And we'll get to that in just a moment. And that's one of the reasons I think a lot of the froth and bubbliness is kind of happening here. It has a lot to do with these flows that are kind of coming in that are seasonal. You also have funds. A lot of the mutual funds, their fiscal year ends in October. So they've already jettisoned all the tax loss selling stuff they want to do. Now is a time where you start to see some of those beaten down shares get reaccumulated as well. And talking about some of the areas of the market where I do think we could have a buoyant year ahead in 2025, I am looking very closely at energy. It is conditional. It is a lot like what I'm talking about for silver. We need to see more demand. We need to see more robust economic activity. Should we see that, I do think the energy sector can take the reins. Remember, if you look at the Permian producers, they're profitable above $45 oil. I know that oil has slipped into the 60s again. There's a lot of hand-wringing in the energy space, and folks are like, boy, if it doesn't get into the 70s, we're never going to make money. If productivity gains continue to build at this pace, where you're able to do U-turn shaped wells, where you're able to use tech to identify more pockets of oil, where you're able to get much more productivity and extraction from a single rig with less hands on deck, all of that means better profit margins over time. These are also companies that have cleaned up their balance sheets. They're either going to be buying smaller companies to grow the amount of oil that they have in their proven reserves, or they're likely to, become acquisition targets, position themselves to be bought by some of the larger companies. So it kind of depends on where you are in the space. But I do think energy is going to be an exciting place in 2025, conditioned on the idea that we get some buoyancy back in the economy and particularly in oil. So if China stimulates, domestic demand comes up, they're one of the largest oil consumers in the world, that would play a role. If the Trump administration engages in more fiscal stimulus and really tries to, kind of make part of their legacy a really robust economy, that could be another area where we could see oil start to take the leads again. And of course, also geopolitical stress. If any of the producers of oil around the world or any of the supply chains shut down or are interrupted from natural disasters or from geopolitical stress, that can also really drive oil prices higher. So I am overall constructive on energy, assuming that we have a decent economy in 2025. I think some of the better run companies in the space can do quite well. And you can see it. If you look at the relative strength of energy companies versus energy prices, investors are showing you the same thing. They're more confident in the stocks than the commodity because they see the same sort of things I'm talking about. Now, I talked about Russell seasonality. Here it is right on screen. The number of months in which IWM closed higher than it opened over the last 9 years. November has been the best month. 90% of the time it is up by an average of 5.6%. So you could say we've already had our November gains. Maybe we have, maybe we haven't. But what really catches my eye about the Russell is the fact that it's broken down. It's really broken out. It's been in this sort of multi-year consolidation since 2021, and every single move higher has been a head fake. This time looks and feels a bit different. I don't know if it lasts beyond this year, but I do think November has the potential to continue to be a pretty decent time for some of these riskier stocks for all the reasons we've discussed. So something to think about if it fits one's trading strategy or investment strategy. I think it's more of a short-term trade. Maybe it's got about 2 or 3 weeks left, but it's still one that's worth watching on the heels of this huge breakout, which in all likelihood unleashes some more buyers, some short covering. And remember, the Russell is the favorite macro short product of hedge funds. So when hedge funds are getting super duper long, whatever area of the market, they're very concentrated. It was Mag 7. Now they're leaning more into some of those old economy stocks we've talked about. They're not extended into those longs, but they're nibbling and growing their net exposure. Well, they also like to short other parts of the market, and often the Russell is their favorite short. So that's something to take into consideration as we navigate throughout the rest of this trading year, that the Russell could be one of those areas where episodically, you could see these gains in it. And part of it could also be hedge funds covering shorts because they become motivated buyers if we keep moving higher. I also think what we saw in crypto miners today was extended by the amount of short positioning by hedge funds. Hedge funds also love to short single stocks. Not only do they short macro products like the Russell or IWM, they do short single stocks as well. And crypto miners have been one of their favorite areas to short. And some of that short interest had been, decent levels of double-digit interest, like 18, 25, 35%. And I do think that part of the reason they ran, some of them up like 30% today, like Mara, was not only did Bitcoin have an incredible surge, but also there were a lot of shorts that became motivated buyers because they were way off sides on those trades. They assumed these things were never going to get back, that it was just a safe place to park your money and fade these things into non-existence. And the unexpected happened, for them at least. Crypto broke out. Now, we've been tracking this for a little while. I suggested that crypto was starting to bottom mid last month. It has. Now it's broken out to new all-time highs. I think it traded 87,000 or so today on Bitcoin. And that was one of the things that helped to push these things higher. But remember, if you're on the wrong side of a short, you've got unlimited potential risk, right? There's no limit to how high something can go. There's every limit to how low it can go. It can only go to zero unless it's crude oil, in which case it can go to negative numbers. But hey, when you look at crypto miners, there is this sort of sense from many in the investing community that this was just done. Like this was just garbage business models. A lot of these things were going to fade into non-existence. Meanwhile, interestingly, just to kind of give credit to human ingenuity, because they had so much GPU capacity, they were actually saying, you know what? If crypto's not going to work out, we're going to throw this stuff at AI and host cloud capacity for language learning models and things like that. And they did, and they monetized that. Some of the better run crypto miners actually really stunned me at how savvy they were and how agile they were. But now they're putting a lot more of that compute back into crypto, and it's yielding because now we're getting to prices where it starts to make sense to mine again. So it's all kind of a long way of saying, look for some of the really shorted small and mid-cap companies that have been totally given up on by many that have catalysts, because you can have motivated buyers both in the momentum trading space and, whomever's watching these catalysts play out, but also on the other side of the ledger where folks are super duper short and this can work against them. They become motivated buyers. And these are also trades that I would only keep on for a very, very, very short period of time, because short squeezes generally don't last very long. And we can talk on the Trader Discord about how I kind of calculate what the potential move is for anyone that's curious. I'm happy to discuss that. Now, we've heard a lot about tariffs, and I do have my own opinion about what this all means. But the first thing I want to talk about is tariffs account for a tiny share of U.S. government receipts. So I'm sorry to break it to anyone that was hoping for an end of the income tax, but that's very unlikely here. In fact, I believe that what we're seeing with the talk about tariffs is the idea that we're going to use that as a negotiating strategy with China. Remember, Trump said 60% tariffs on China. That was his kind of baseline. It's obvious to me that no one wants 60% tariffs anywhere, because it would induce both economic hardship and potential inflation, because a lot of that cost push is going to come to the end consumer. At the end of the line, there's very few companies that can absorb a 60% increase in cost without passing some or all of that on. right? And if you pass it on and people can't afford it, then you just see a slowdown in economic activity for those goods. So I don't think we're seeing a 60% tariff. I do think tariffs could rise on China, and they probably will. But I think that talking point was about creating negotiating leverage. Now, some folks have said, well, if you just raise prices enough, if you just increase tariffs enough, that'll bring jobs back home and that'll bring manufacturing back. Well, we've been raising tariffs for many years, really for the last seven and a half years overall. And you can see manufacturing has been in its own sort of rolling recession on and off for several years. You can look at various aggregates of manufacturing data and see that. So if this was supposed to be the cure-all, we should see manufacturing going gangbusters in the US. Instead, there's reshoring, where companies go to countries that are less impacted by tariffs, but also still have lower costs of labor, less environmental regulation and regulation as a whole, so they can still gain those additional margin cushioning driven by a lower cost of producing goods. So you look at Vietnam, you look at Mexico, you look at Indonesia, there's a number, even look at India to some degree, there's a number of different countries around the world that are capitalizing on that reshoring boom, but it hasn't really benefited US manufacturing that much, at least yet. Maybe that'll change in time. But I think that the impulse for higher tariffs is companies are still able to find goods production in other parts of the world that is cheaper, and probably with some countries, at least in some cases, that are less antagonistic to the United States and its interests than China as well. So my opinion is Trump will come in, he'll say, we want to get a more equitable trade relationship with China, and he'll accomplish that by basically using a carrot and stick approach. The tariffs will be the stick. And the carrot will be, if you buy more of our goods and services and we reduce our trade deficit with your country, then we're not going to have as big of a stick. So 60% tariffs could become 10 or 20% tariffs. It's still an increase, but it's not something that's going to be as problematic for the U.S. consumer or for U.S. companies. Because remember, tariffs are paid ultimately by the businesses that are buying the products from overseas, and a lot of that is passed on to the consumer. So no one wants to see the consumer get hurt here. And that's one of the other reasons I think this is a negotiating tactic, and really you couldn't think of a better time to do it. China's struggling. The pressure there is real. I know it doesn't get talked about really that much, but their economy is in serious trouble. And the amount of stimulus that they've been doing is woefully insufficient, as we can see. Now, yes, there's still some more time left in the year, but if we look at the prior years as to where we were through September, and then we look at where we are, right now, we're basically at the same place we were last year or 2021 or 2020. There's not that robust growth in fiscal spend, and there needs to be, because there's a tremendous overhang in the Chinese economy of all of that real estate. And real estate's the largest asset class in China. And their real estate market is the largest market of any in the world, if we're to believe their valuations, which last checked was around $60 trillion. So it's an enormous market. But they're not stimulating it. And unfortunately, because Chinese savers are largely where they have money and they're fortunate enough to invest in real estate, until that asset class starts to improve, the Chinese economy will not really get off the mat. Yes, we had an impressive rally in Chinese equities. It's completely stalled out at this point because the last meeting from the National People's Congress, which the abbreviation for that is NPC, not to be confused with non-player character, if you catch the reference, but that was disappointing to the market. They did not do enough. Okay, so in China, there was this idea that there was going to be this giant amount of stimulus that was going to come out and really kind of salve the markets and get things going in the economy again. And you know what? This time they pulled back because Trump won. You're probably asking yourself, why? Why does that matter? So what the discussion in China has become at this point is, okay, so now we're having to deal with this sort of series of potential escalations in the trade war. What's that going to mean for our economy? And how do we create some resilience? So the overall consensus is China now and this is based on their own internal discussions, as well as the views of economists that have been observing the Chinese economy and their government's interventions, is that China's holding off to see what the Trump administration's trade agenda really is, and then they'll respond with fiscal stimulus as they feel it helps to make their economy more resilient against any kind of threats from an escalation in the trade war. So I think that with that in mind, we may reasonably expect that 2025 could be a better year for China. But again, like I was talking about on silver, we need to see it. We need to see stimulus in China that specifically is targeting domestic demand improvement, improving the confidence of savers and spenders in the country. Unless and until we do that, and in sufficient size, China's not going to go very far. But once we do, I think that a whole host of industrial metals, Chinese stocks obviously beneficiaries, but also industrial metals, silver, iron ore, copper, platinum, palladium, etc., will all have pretty significant gains. So that's something to keep in mind that, yeah, we've been playing a waiting game for quite some time. And eventually, someday, we'll see China stimulate, and it'll probably be more impressive than what it's been. We've had 2 years of sort of fool me, what? It's not fool me once, it's not fool me twice, it's not fool me thrice. Like we're on like fool me number 8 or something at this point. But eventually, they are going to do something more significant, not because they necessarily want to, but because there's really going to be no choices left to get their economy off the mat. So let's also talk about some opportunities. Then we're going to get into questions and answers. For anyone that has any questions, I do want to take those and discuss them. But for now, let's get into some of the opportunities that I am watching for the rest of this year and the year ahead. So we talked about the idea that old economy stocks are likely to perform in an environment where there's going to be deregulation and emphasis on them, and then probably some increased scrutiny of tech. We know that if the GOP has this full sweep, which all signs point to them having the majority in the House, we already know they have the majority in the Senate, they've got the White House, which means we'll probably see more scrutiny of big tech. And I think in particular, in their crosshairs, we'll have Google and Microsoft, but it could be some of the others as well. Maybe Meta falls into their crosshairs. Maybe Amazon, although Mark Zuckerberg complimented Trump's response to that assassination attempt, calling him brave and kind of giving him some kudos. Jeff Bezos said the same, and then also ensured the Washington Post didn't endorse Harris. So maybe that's enough to kind of give him a little something. You never know. I look at all these things. They're little cookie crumbs along the way. We'd be remiss if we didn't pay attention to them. So at the very least, Google and Microsoft could be in the crosshairs. Google's already in the crosshairs of the DOJ. And then across the pond in Europe, NVIDIA could be in their crosshairs to some degree, right? It's just, the investigation's already open. So we just have to open our mind to what are the possibilities in the year ahead. So this is why I think some of the older economy parts of the market and some nuance, you can see cybersecurity and SaaS is in there too, and I'll talk about why. But aerospace and defense, we're in a world full of uncertainty. We've got the war in Ukraine with Russia. Maybe that will make progress towards peace under Trump. Maybe it won't. We don't know. We also don't know what the implications of something like that are, and if it is really a global de-escalation or if it just leads to other episodic wars. We also have the situation with Israel and Palestine, and really Israel versus Iran. That's really what's going on there, if we're being very honest about it, because Hezbollah and Hamas are just basically Iranian proxies, right? That they're really just fighting proxy wars there. Same with the Houthis in Yemen. So you've got 3 Iranian proxies fighting Israel, and wherever that goes and however that winds up, there are some potential stresses there that add to uncertainty in energy markets, but also add to demand for aerospace and defense. I think those trends are set to continue. You also have whatever uncertainty happens with North Korea and with China versus Taiwan. I don't think those are 2025 stories per se, but they're at least kind of powder kegs lacking kindling, and should something happen there, that would be another sort of right tail catalyst. We also have commodities. If we do have a robust growth cycle in 2025, I do think commodities get a pretty significant bid. And I'd be looking most especially at industrial metals and energy. Those would be the two areas where I think we could get the strongest bid, because I think 2025 could also be a year about infrastructure, about updating, about building, and about growth. Again, you've got this global credit cycle in its early stages as central banks around the world are cutting. You have a lot of infrastructure to build in the developing world and a lot of infrastructure to update in the developed world. So I think that could be a theme that we look at as to how some of that fiscal stimulus is doled out in various countries. We also have cybersecurity. Cybersecurity has not performed the way that a lot of the other techs have. It's lagged a bit behind. Obviously, we had the CrowdStrike issue this year. That was specific to that company. On the other side of it, however, the amount of hacking activity that's going on is unlike anything we've ever seen before. And I mean, it is incredibly bad. And it has to do with several different trends. Hackers are getting better at hacking. You have more money chasing hacking because it's become a business. You like these guys that don't have any ethics, they can make a ton of money hacking. So you have organized crime groups that operate like corporations, and you have hacking as a service. That's a thing. Imagine you can rent a botnet to spread ransomware. You can rent a botnet to do a denial of service attack against your competitor. You can rent all kinds of different capabilities to, basically, if you don't know anything about computers, still have the sophistication of a threat actor that is a state level or a corporate espionage level threat actor. So the cybersecurity threats are real. And then on the other side of it, businesses are not spending on defense. So one trend that we've seen that's been a bit of a laggard in the space is that businesses are simply kind of ignoring the threat and how significant it is out there, which is one of the reasons we have these rolling episodes of breaches sector by sector, whether it's healthcare. We saw it in casinos in Vegas. We've seen it with airlines. We've seen it with municipal power and water, and even municipalities like their police departments getting hacked. I mean, like anything that isn't offline is getting hacked. I mean, name an industry or name a government, and it's likely there's been several big data breaches over the last several years. Some of these are by crime groups. Some of them are by foreign governments, right? And those threats are only growing, and the cost of responding to those threats is far more significant than defense. So I do think, and we've heard a little bit more about this, we'll see countries around the world, perhaps the United States, but certainly others, increase the amount of what is necessary to have cybersecurity through regulation, right? Carrot and stick approach. You'll be rewarded for compliance. You'll be punished for the lack thereof. You've already seen a lot of it at the state level too. It doesn't have to be the federal government in the United States that does this. States can also ratchet up requirements for disclosure, for baseline security, for privacy and otherwise that creates compulsory spend. You can also have it happen from cybersecurity insurance, which has become more and more popular, and insurance providers have been taken to the bank this year. Because with all those breaches and all those companies getting hacked, any of them that are doing the bare minimum requirements to qualify for coverage are getting payouts. There's even some talk in the government of banning cybersecurity insurance from doing ransomware payouts. Now, all of this being said, what it really tells us is the cybersecurity insurance industry has every financial motivation to increase requirements for their customers, right? So all these things, the hacks, the potential increased regulation, the shift in how we're looking at cybersecurity insurance, and the increased sort of threatscape, you could call it, out there, that all compels higher cybersecurity spend moving forward. So I do think we'll continue to see that spend increase in 2025. And I think the cybersecurity industry, some of the better run players, SentinelOne is one that I have an eye on. Palo Alto is another, but we'll talk about more of these on TraderAid. These have been names that I've been kind of discussing for a while. I also think maybe it's time to get back into Qualys. We got back into that trade as a long-term swing, and we're very handsomely rewarded for that from their earnings, which they beat out of the park. So we'll see. There's going to be a lot of opportunities in that space. There's also energy. We talked about that a bit earlier. But I think up and downstream, the larger companies are going to be buying the smaller companies. So the really well-run companies, they have that opportunity to be bought out at a premium. So for the shorter term investments, that's where I'd be looking at the sort of clean balance sheets, cash flow positive, lots of resources, or otherwise invaluable smaller to mid-size producers and refiners. And then the really, really big companies, the Exxons, the Chevrons, even the Occidentals, companies like that, are going to likely continue to grow. I mean, Exxon basically pulls oil out of the Permian for about $35, $40 a barrel. So they're profitable unless oil prices go significantly lower from here. We've got industrials. We've already seen it in stocks like GE Aerospace until recently. They were doing really well. Aerospace and defense does qualify for industrials as well. You've also got companies like Honeywell. I feel like the entire industrial space, Johnson Controls, these others, they're likely to continue to see demand. And it's part of that 2025 story of likely seeing more spend on infrastructure, more build out, more updating that could help these industries really start to excel. Key emerging markets are another area. We'll talk about that more on TraderAid, but I do still like looking at places like Malaysia, for example, that I think has room to run, like Philippines, that I think has room to run. And, eventually we'll be looking at getting back into places like India and Mexico and Vietnam as well. We'll be targeting that based on the overlay of momentum and the macro picture. There's also materials companies like the XME ETF gives us pretty broad distribution of exposure to those. There's metals and mining. I'm most bullish on looking at things like copper miners, silver miners, platinum miners going into next year, assuming we get that kind of stimulus that we're expecting. And then there's SaaS and real AI. Now, one example of a real AI company that's been going gangbusters that you all know I've been very bullish of for a while is Palantir. My cost basis on that one's $7 a share. It's my biggest position. I mean, the growth is kind of ensured that's the case. I don't really have much plan of trimming. I just sell covered calls during episodes of elevated volatility. And then if shares get taken out, I sell puts until they get put back in. It's a pretty simple options wheel strategy for a long-term holding that lets me capitalize on vol. But there's a lot of underappreciated, underpriced SaaS companies. We've had this huge bid concentrated in like the big six techs. You've had Google, Apple, Amazon, Microsoft, et cetera. That's been really NVIDIA. You had that kind of focus, but there's been a lot of mid caps that have been left behind in the SaaS space. Palantir was one of them. Obviously, you can't say that anymore, but I do think you will see that bid come back because there's just such a differential in valuation. And some of these companies are really posting impressive growth, and they've been ignored by the market until very recently. So that's kind of the game plan going into the close of this year and into next year. And now I want to open up the floor for any questions that anyone out there may have for me as we're wrapping up this episode of Navigating the Markets. Sure, yeah, I'll be covering that on the TraderAid Discord for real AI companies besides Palantir. There are some that I'm researching now, and I'll have some trade ideas and investment ideas for that space for 2025. Sure, yeah. So Philippines is a very interesting and dynamic economy that is a beneficiary of everything that is not good for China. They are one of the reshoring destinations, particularly for electronics and chemicals and other things. So I think, and textiles. So I think that what is detrimental to China is beneficial to the Philippines. And I'm happy to go into more detail about that later. I don't know a whole lot about MP. That is a stock Aisha knows a lot more about than I do. But for now, I really like getting more broad-based exposure to the materials space. And that's going to be a story where I would be talking about averaging in over the next 3 to 6 months. So XME, the materials ETF, would be one that I'd be looking at specifically. Yeah, you're welcome, folks. Do y'all have any more questions for me? I know we've been here for about an hour. I want to be mindful. Your time is valuable. Loving the new levels and pivots on the stream. You mentioned gold. Do you have any thoughts on a miner like NEM after this recent drop? Thanks, Strikes and Gutters. Yeah, so first, thank you so much for mentioning the pivots and all that. I mean, that's been a work in progress for a little while. I'm so happy that you all like it because like everything else, these are tools that I would use for my own trading, and I do use for my own trading, and that's why I build them. And then when I realize how valuable they are, I start, kind of making them more widely available to our community. So the pivots have been part of that effort, and I think they've been pretty helpful in that respect. So gold miners, I like Agnico Eagle. I think that's a really well-run gold miner. But I also like the streamers. I like Wheaton Precious Metals, WPM. And then if you're in for something super duper speculative, and I mean super duper speculative, so like super duper small position lottery ticket type thing, Rio 2, which is Rio.V on the Toronto Venture Exchange, and Rio FF on the OTCs. Yes, it is an OTC for now, but I know the management. They have all the permits they need. They've secured capital actually from Wheaton Precious Metals. It's a very small world, isn't it? But this is a company that I think, if all goes well, knock on head in place of wood, could be a 5 to 10 bagger. So Rio 2, run by Alex Black, that's my favorite spec play in the junior gold miners. They haven't started production yet, but they have secured the permits in Chile, which is extremely challenging, and they have secured financing. So there's really, at this point, only operational risk moving forward. NVIDIA, Charlotte K asks, is NVIDIA a secure long-term hold? And goes on to say, SMCI with its issues, what are your thoughts on the way forward for the company? So I think they're two very different paths and two very different companies. And also, Kay Wagner said, great stuff, Markets and Mayhem. Thank you so much, my friend. I appreciate you. So NVIDIA, I think the biggest risk for NVIDIA is their success. Okay, they have built a monopoly. We can't honestly say it's anything else when they have 95% market share in the data center space. And they have 80% margins as a result, right? You pretty much have to buy NVIDIA, because if you don't, you're not able to use CUDA. And if you're not able to use CUDA, you lose out on a lot of developer market share, or mind share, I guess I could say. And also this whole ecosystem of AI apps that's sort of off the shelf, ready to use. There have been abstraction layers for CUDA built. One of them was Luda. It's a mouthful, ZLUDA. That got a cease and desist by NVIDIA. But before that, it was able to run CUDA code on AMD and Intel GPUs. So what that gives you a sense of, and if you look at the raw hardware, if you take out the CUDA component of it for a moment, you just look at the raw hardware, AMD, Intel, Broadcom, Qualcomm, they all have competing products that are as good, if not better, than what NVIDIA currently has on the market. Blackwell could change the game a little bit, but they're already very solid competing products, but they don't have the software ecosystem. So the AMD MI300, for example, is actually a faster GPU, cheaper with twice the memory. But because CUDA doesn't exist for it yet, people aren't really buying them quite as much. So long story short, for NVIDIA, their risk is regulatory. The company is firing on all cylinders. Management is, doing incredibly well, but I think they've been just a little bit too aggressive on their monopoly strategy, and I think that's going to work against them. And I think the European Union is likely to crack down on them in 2025 and open up CUDA to more competition, at least in the Eurozone, but that could spread globally. And that would be problematic, because then all of a sudden, those 80% margins are probably going to be cut in half or lower, right? So I think for now, NVIDIA's okay. I think that the biggest risk they face in the intermediate term is regulatory risk. I think the other component we need to concern ourselves with is semiconductors are cyclical by nature. So whenever this sort of AI cycle of generative AI starts to reach that disillusionment trough in the Gartner hype cycle, when people start to realize that, yes, it has a lot of potential, but we're not there yet, we could see that AI CapEx that's driven NVIDIA's rally slow down as well. So those are the two biggest risks, right? It's the monopoly, seeing some regulatory oversight, and then it's also what could happen over time with enterprise spend in an area where many companies are still having some trouble monetizing it. If we look at a company like Palantir, for example, they're not reliant on NVIDIA GPUs to sell their AI. They're one of the few AI SaaS stories that's immensely successful, and it has nothing to do with NVIDIA. So that's the two parts for NVIDIA. Watch the regulatory response, particularly from Europe. And then also watch what may be happening with overall AI CapEx from these earnings calls. Right now, companies are still full speed ahead. That could start to change in the quarters ahead. So as a very long-term holding, it's probably okay. But if you look at how much it's appreciated, where its valuation is, and the risks to growth for those two scenarios I pointed out, I don't know that I would necessarily want it to be a very large position after the run it's had. SMCI is a totally different story. NVIDIA has some degree of competitive advantage, especially if they are able to keep their monopoly. Then they have the ultimate competitive advantage with CUDA. SMCI has no competitive advantage at all. They make a commodity, and that commodity is the motherboard and chassis and the cooling that these systems go into. So SMCI is essentially a company where what they're doing is they're just selling off the shelf and custom hardware, and everything that they sell, Dell and HP Enterprise can sell, and they can sell without even having to charge any profit margin for it. And they're willing to do that. In fact, you saw Dell get skewered in prior quarters for selling AI servers with no margin. Investors are like, what are you doing? Why are you doing that? It makes no sense. Actually makes all the sense in the world. If you look at what Amazon did in their early days, they consume market share by embracing the Bezosian philosophy of, your margin is my opportunity. So Michael Dell took that same approach to heart and said, SMCI's margin's my opportunity. We're going to take our reputable name, and Dell has a very trusted name in the space, both businesses, obviously, and consumers. We're going to take our brand and we're going to bring it to this AI GPU server space. And they did, and they're quite successful there. So is HP Enterprise. So the biggest advantage that SMCI apparently had was more the first mover advantage. They were one of the first companies really integrating these things. And you saw analysts kind of showing us they really didn't understand this space when you saw notes out from like Rosenblatt Securities earlier this year. And the note said, SMCI has a competitive advantage because of their liquid cooling. And this is something that like you only really see in supercomputers. And I'm thinking there, wow, that doesn't make any sense at all. Like I remember 15 years ago, we were putting liquid cooling into hobbyist level computers. Like there's no competitive advantage in putting tubes with liquid and pumps into a computer and attaching those to heat sinks to transport heat away. But that was what the industry was looking at, which told you one thing. They didn't understand the story at SMCI. Then you've got management lying about their accounting. Repeatedly. Like this isn't even the first time. They are repeatedly lying about their accounting. That is an enormous red flag about the ethics of a company. Now, if it happens once and they fire everyone responsible and they own it and then you don't see a pattern, that's one thing. But if it happens repeatedly over time and the same decision makers remain in place that are likely behind it, that's a whole other matter altogether. And that's where we are with SMCI, where I think there's a decent chance if they don't get their act together very soon, they could be delisted. And then they'll face about $1.85 billion in bond repayments. And at that point, this is not a company that will last much longer if that sort of series of dominoes goes off. So I would be pretty concerned about SMCI here. I don't think that this is a company that, you really want to be getting too much exposure in because management has shown themselves to be dishonest at the same time that competition has shown themselves to be able to eat their entire lunch. And I started to talk about this in April of this year that I felt like Dell and HPE were going to eat SMCI's lunch. And we're seeing it play out right before our very eyes, just as their accounting shenanigans get so bad that not only one, but two different auditors have fired them, the latest being Ernst & Young, a company who's so full of scandals. They served Enron. I believe they also served Wirecard. They served Lehman Brothers, and their reputation is so much in tatters that they've changed their name to EY from Ernst & Young just to try to get away from their name. Like that's a really crappy thing to do to try to confuse the market because you're such a scandal-filled company. So that company fired SMCI. So if you think about it, like how bad do you have to be to get fired by Ernst & Young? You have to be SMCI bad. I don't want to touch that thing ever. Like I've shorted it. I've made some money on puts. And at this point, like all the hot air's out of the bag. I don't want to touch it again. I think it's going to be a pink sheet in not too long. Yeah, just an all-star lineup for corporate conflicts. Exactly. It's really remarkable stuff. Wondering why Elon Musk opted to go with SMCI instead of Dell. And if that's correct, what happens? I don't know. I don't know why that decision was made. If I had to guess, it's probably all just based on total contract pricing. We also have to remember there was a time where Dell hadn't really scaled in AI GPUs, and now they really are. So maybe at that time they didn't have the scale, or maybe SMCI gave them the most competitive bid. It's hard to say. But, it's all pretty much relatively off the shelf kind of stuff. So even if SMCI isn't a going concern anymore, Tesla does have the engineering acumen to sort of maintain things and replace them as they need to. So do a lot of the other companies that are SMCI customers. You can bring in third-party specialists from like Dell or HPE or consultancies to make up that gap if there's a knowledge gap in that, like an institutional knowledge gap. So I wouldn't be too concerned about that. I think the companies that bought this stuff will be okay. I think the bigger risk is that SMCI investors, they're the ones that were buying at those triple digit levels, post-split. Even the ones that were buying at like $30, $40 a share, they may not get that money back. This is pretty much likely a very, very effed company. Yeah, AMD's got a lot of problems. I like the company, but I don't like it as an investment right now because the more I look at it, the more I see some serious problems with their execution and leadership. And I respect Dr. Lisa Su. Believe it or not, she's the cousin of Jensen Huang, NVIDIA fame, right? AMD has made some decisions that over the last several years have really cost them a lot. One of those decisions was to buy Xilinx. That is a decision that they continue to lament. And this was at the height of high performance computing. They bought Xilinx at like the top of the high performance computing bubble. And they've been writing down the goodwill of that acquisition ever since. And the president of Xilinx just stepped down. Like they bought the company. They wanted him to be the president of AMD and to be part of the leadership team. He just stepped down because of how badly that's all gone. And I'm concerned about that. I'm also concerned about AMD's announcement that they're not going to be making high-end GPUs for video cards for gamers, not only because that's a segment where they should be competing with NVIDIA because no one else is, but it's also important because there's so much overlap between that and the GPUs you put in the data center that you may as well sell that compute to consumers. It just adds another flow of demand. Like if you look at NVIDIA's Hopper or Blackwell chips, those are going into both their data center grade hardware and their consumer cards. It's just, varied levels of capability of total VRAM, of the amount of GPU compute and so forth. Well, AMD, they bifurcated the path of data center grade GPU and consumer GPU until very recently. Now they're merging them back under, I think it's going to be going back under RDNA. But the problem is AMD has basically said, we're not super interested in making ultra high-end video cards for the consumer. Well, you're not only losing out on gamers, you're also losing out on AI enthusiasts and video editors and graphics, like CGI folks and all kinds of other people that would be buying those cards ordinarily. You're missing the opportunity to build market share there that can be invaluable over time. So I think that was another big mistake. And then, the other problem with AMD is now they're going on an AI buying spree. They're buying several different companies. One of them is like a AI GPU-centric server builder and integrator. Another one is a unproven startup, I think from Finland or Sweden, one of those Northern European countries. This is Lisa Su at it again. We're definitely close to peak AI mania here. Like, we've gotten way more excited about what this stuff can do in the near term than what it's capable of doing in the near term. And that's something to be concerned about because AMD kind of perennially likes to buy things when they're at the height of hype. That seems to be a bit of a trend here. So I'm a little concerned that they're making the same mistake again. And these could be acquisitions where they have to write down a lot of the goodwill again. And like you said, that can eventually put more pressure on their valuation. Right? Their forward PE right now is 2860, but if they start writing down some of the goodwill from these acquisitions, that shoots right back up again. And then their valuation gets called into question, justifiably so. So I think that in the long run, they're a good company, but management needs to get their act together. Micron, I think, is a beneficiary from increasing demand for flash memory and for RAM. And Aisha and I were talking about Micron recently as well. And I think this was one of the trade ideas she gave to Charles Payne when she was on Fox Business recently. But I like Micron. I like it both on its chart. I think that we're actually seeing it coming off of lows and really starting to break out. We just saw a push above the 200-day moving average last week, and then we tested it and held that in the 20-day today. So from a momentum perspective, I like it. But also, if we look at the fundamentals, forward PE trading about 8.5, we have a company that is the beneficiary of dual tailwinds, increasing demand for both short and long-term memory, as I like to call it, or RAM, the short-term memory, and flash, or SSDs or NVMe storage, the longer-term memory. Micron makes both, and they actually do it quite well. So I think Micron is one of the semiconductors where I actually still think there's decent upside. They have had management and execution issues, without a doubt. But overall, I'd be more constructive on Micron here than AMD over the next quarter or two. Yeah, Qualcomm is a really well-run company. And if you look at, and Johnny Danksy, what's up, my friend? Great to see you. If you look at what Qualcomm is doing in the mobile computing space right now, the Qualcomm powered Microsoft Surface computers and Dell laptops and otherwise, they have insane battery life. It's like 27 hours of constant usage battery life with equivalent performance of the higher end Intel processors. There is nothing else out there like it. They could very, very solidly disrupt the laptop and tablet computing space while simultaneously unleashing a wave of processors into the mobile, the handheld space that are equivalent to laptops. So imagine having a phone with the power of a laptop. All that is on the Qualcomm roadmap. I know there's concerns about the litigation with ARM and ARM pulling licensing. I don't think it's going to matter. A, Qualcomm claims that they have their own ARM derivative tech at this point, that it's unique enough from the patents that it isn't a threat. But B, Qualcomm also is a formidable company. So even if it is found that it's somehow an infraction on licensing, they'll pay whatever dues there are and they'll differentiate the next iteration of technology enough that it's not offending. I don't believe it is in its current form, but nevertheless, Qualcomm also has a similarly constructive chart here. So I would be looking at that one, particularly if it can make a move above 180 as a momentum driven play. Snow, I'm not a huge fan of Snow. I just don't see the value proposition. It's basically just a data lake and analytics company. A lot of the stuff they do, you can do elsewhere for significantly cheaper and with better levels of security. If you heard earlier this year, AT&T had a big data breach, like every single one of their customers' data was breached. That was because their data at Snow was breached. And this is what happens when you take sensitive data, you farm it out to a company like Snow, and then you see kind of what happens when it isn't stored securely on their data leak. Not funny. Data leak, very similar. So, one of the companies that competes with Snow is Palantir in some ways. And I would say their data analytics platform is much more formidable. Foundry. I would not be buying Palantir at current valuation. I think that would be a mistake in the short run. But on a big pullback, I think a company like Palantir would be reasonably attractive to consider. Another one to look at that's a potential competitor. It's similar. I wouldn't say it's really a potential competitor, but it's in the similar space would be Datadog. Cloudflare, I do like Net. I think that's a great company for the long term. The management's ethical alignment is a little questionable, and they are running in a lot of different directions at the same time. But overall, they're becoming an irreplaceable platform, right? They're basically becoming indispensable for a lot of their customers because they're going into so many different areas. Cloudflare is actually set to disrupt Zscaler. That's their Zscaler. I'm sorry. Zscaler is one of the companies that Cloudflare has in their targets, and they can actually do pretty well against that company. So I do like them over the long run. I do have an investment, full disclosure, in Net and in Palantir. Palantir is my biggest holding right now, and it has been since a $7 cost basis. And I'm still looking at that company thinking, this still has room to go over the long term. It's still in its early stages. I think I tweeted out in 2021, May of 2021, I think this will eventually be one of the biggest companies in the world. This was at a time where a lot of people didn't like them, or they were confused, or they couldn't really figure out, what it is the company did. And, I've been a tech guy for long enough that I kind of saw all the pieces coming together with what was a real AI story early on. I was fortunate enough to be able to capitalize on some of those volatile episodes in 2022 and build that position at an even lower cost basis than the DPO, which I think came out at about $9. But anyhow, I'm going to wrap it up here because I do want to be respectful of everyone's time. We've been at it for about an hour 20. And I think this has been an awesome episode of Navigating the Markets. I hope you all enjoyed it. Of course, if you have questions for me, ask on the Discord anytime in the questions room. Let me know. And I'm always happy to help. That's what we're all about at TraderAid, is helping people navigate these markets, learning skills so we can become more self-sufficient traders and investors. And that's what I'm all about. I think that's like the quintessential part of becoming a trader. It's not just, kind of looking at what others are doing. That's what we do in our early stages, kind of figuring things out and getting our feel for the market. But as we go on, we want to become self-sufficient. So that's why we focus on also building trading tools, education, and a community. The things we need that are foundational for us over the long run after we get through the phase of just kind of learning the basics of trading. So I really want to thank you all for tuning in. This has been a lot of fun. If you didn't catch the whole thing, do be aware we will have this recorded and posted on the website in not too long, probably about an hour or so. So thanks again, folks. Have a wonderful rest of your week, and I'll catch you around the Discord.